Alrighty, we are ready to get started today. How's everyone doing? Hope you are doing well. My name is Andrew Kuhn. Thank you very much for tuning into the Focus Compounding Podcast. Sitting across the table from Mr. Geoff Gannon. Geoff, how's it going?
It's going great, Andrew. How's it going with you?
It is going fantastic. I'm very excited because we had spoken to Vetla in our last podcast, and we are going to be speaking to him again here today. Of course, this is the audio part of our business. If you do want to get access to our investment idea website, go to focuscompounding.com and be sure to sign up using the podcast promo code, which is podcast, and they'll take $10 off of the monthly price indefinitely as long as you stay a member. So it's an ever-growing community and lots of fun.
You get to read the write-up of the stock we're going to talk about today.
You do.
And you get to read the write-up of the stock that we talked about last episode.
You got it. And I'm really excited to talk about this because it was actually one of the most talked about idea on our website.
Yeah, this is the most ever talked about.
It had a lot of comments from a bunch of different members, so it definitely drew up a lot of interest. So who else to talk about other than the man himself that wrote about the idea? So Vetla, all the way from Norway, how are you doing today, man?
I'm good. Glad to be back.
Glad to be back. That is right, and and we're glad to have you back. Even though we just recorded the other podcast, but we're glad to have you back here today.
Let's pretend
everyone knows we pre-record, so we're not hiding anything here. So you wrote about Entercom Communications.
I did,
which is the second largest radio station owner in the United States. And you said that it trades at a lower EV to EBITDA than its debt-laden peers, which that was a great title, by the way. I think that drew a lot of people in. So for people that don't know, and just a little bit of a background, the ticker that we're going to be referencing is ETM, and then it was involved in a reverse Morris trust situation. So CBS spun off their CBS radio division and then merged it with Entercom Communications. And you wrote up the stock around $10.50 and it's currently trading at $7.85.
Yeah,
so maybe if you want to, with that introduction or that preamble, you could sort of take it from there and tell us, I guess, what drew you to Entercom. Me personally, I don't think I came across that idea. But so like how'd that come up on your radar and then sort of go from there?
Okay. So I got it from Clark Value Investing. He wrote a small piece about it right after the merger in last November. And I was intrigued by what he wrote about it. So I decided to look further into the case. And I really liked most things about it. I liked the business is easy to understand. It was trading at extremely low multiples. It has a lot of free cash flow. And the management seems honest and competent. And the founder owns a lot of the stocks, and he's bought a lot of shares over the past year or so. And the company has actually only had two CEOs over its whole lifetime, which is first the founder, Joseph Field, and then his son, David Field. So the management has basically dedicated their whole life to the business. And that's about it. But it's a very risky stock. It's a highly leveraged stock. And you mentioned they acquired CBS Radio, which is 3 times larger than them.
Yeah, and I think is that what a lot of people are sort of worried about with Entercom, and that along with radio, I guess the general consensus of where it's going to be.
Mm-hmm. There are two huge risks here. That's one, do they have too much debt? And two, is radio an out-of-date medium?
Yeah, and I think I would agree. Geoff and I too. I don't want to speak for you, Geoff, but everything that he said was what I guess drew us to the situation as well. That and the actual business itself is more of a capital light business. Mm-hmm. He hit on that with extremely free cash flow generative. So what do you? I mean, obviously the general consensus thinks about radio dying, and I think that's what obviously the bear case would be for this company, along with how much leverage it has. What is your general thoughts on radio? Is it dying to you? Do you think that's something that is really more of a it's more of a like a soundbite more than anything, or what are your general thoughts on that?
I personally do not think that radio is dying. Like a lot of people, they say it's dying because now we have Spotify. Who needs radio when we have Spotify? We got all the artists and all the songs in the world on our phones. Then why do we need radio? But I think that is a flawed argument. For instance, you don't get like the same sense of exploration when you listen to Spotify. You can get tired of even your own music. Like, for instance, my favorite part about Spotify is Discover Weekly, which is a part of it where you get like 30 songs you never heard before. So I guess the main reason why I like radio and why I think it will prevail is that you can just turn it on and you have a fresh stream of background noise that you can tune like in and out of. Like, you make breakfast, you have radio on, you can listen to it if you want to. There's a sense of choice in there that you don't get with Spotify. And like, people get tired of their own podcasts sometimes, which is why radio talk shows can be a better option. It's just comfortable to turn on the radio and listen to whatever is on there. And it's not like the rise of Spotify is the first time another medium or another way of listening to music threatens radio. Radio survived tapes, turntables, CDs, then the iPod. But now Spotify is going to end it all? I don't think so. At least not over the medium term.
And a lot of,
so, yeah.
And a lot of the stations they own would be like sports, local news format, weather, traffic, those sorts of things too, in addition to just that they're playing music.
Oh, yeah, it's not just music. Yeah, they got news channels, weather channels, and, of course, sports channels, which you basically have a monopoly on in certain places. Like, they have contracts with with like all the major league teams, or some of them. So sports fans will tune in to their team's radio channel and then listen to whatever is the recent news within their team.
Sure.
So, yeah.
Yeah, sure. And you did also write about that they do own radio.com. Can you speak to what that is for the people that aren't familiar with?
So radio.com is really just like an online news site for music news, basically. But it's not an asset for the company, really. It doesn't really bring in any revenue. It's just like I think it's just good marketing material for your investors to say, hey, we own this. But I wouldn't say that radio.com is important in valuing the company.
And they also do podcasts, right? But
they do.
Yeah.
I think they're actually one of the biggest podcast creators in the world, or in America.
Do you think that's material to the company or not?
Not really.
Yeah.
Not really. I think they're the second largest podcaster on the market, but they're not going to generate any revenue from that.
Right. So radio is an advertiser-supported medium. So what people are caring about most is sort of what the ad rates are and what people are buying, what they're advertising locally on those stations. That's what drives revenue?
Yes, basically, yes. And a lot of people fear that there's no need for advertisers to advertise on radio when you have the opportunity to advertise to like very, very, very specific people on stuff like Facebook and Instagram, basically digitally. But there are several companies that don't need to advertise to very, very specific people, like people in between the age of 22 and 27. There are males that like soccer or whatever. Mm-hmm. Like, for instance, Procter & Gamble, they create all sorts of stuff. So they don't really need to advertise they don't really need a target audience. They can just advertise to whomever. And Procter & Gamble actually deemed a $100 million investment in digital ads ineffective. That's what they said, largely ineffective. And they said they would advertise more and more, that's a quote, more and more into radio. So people or companies are actually going back to radio. Perhaps they've overestimated the efficiency of digital ads, and they're underestimated the audience of radio, and now they might, and which is what Wall Street has done as well. They're like turned their backs on radio. So it's like so maybe radio will survive these headwinds.
Mm-hmm. But if there was a recession or something, we would expect ad prices to drop for radio.
Oh yeah, definitely. That's the first thing. The first thing that companies will cut is advertising. Mm-hmm. Like you did the write up on Omnicom, mm-hmm. So you've seen that firsthand with Omnicom.
Yeah, and so is that a concern when you add that up with their debt? What would happen in a recession?
It is. They just bought. They just swallowed a company which is 3 times larger than themselves, and it's difficult. It's almost impossible to argue that this is like the beginning or the middle of a bull cycle. Mm-hmm. So they're putting a lot of risk on themselves here, and we might see a recession soon, which could be very bad for the company.
What was the rationale for swallowing a company 3 times bigger than themselves?
CBS Radio were not performing very well, and they believed they could turn it around, and they wanted to gain economics of scale.
Yeah.
So they're considered a much better operator than CBS
And
Radio,
I think
right?
that's what it is.
Yes.
Yeah, that's what I mean.
CBS Radio underperformed just about any other radio company out there.
And CBS probably thought that CBS Radio, not under their umbrella, could obviously probably do better, especially with Entercom, people that dedicated their whole lives to the business.
Yeah, exactly. And I know that the founder, Joseph Field, he was like a pioneer within the radio industry. He created Entercom then when FM was still like up and coming. He just saw that FM broadcasting was better, was more efficient than AM, so he decided to start Entercom to help FM gain more audience. So it was founded in 1968, and it was not before 10 years later that more people listened to FM radio channels than AM radio channels, even though people knew that FM channels were better than AM channels.
Got it. And, we're sort of talking about, obviously, about also like the industry and stuff. Why do you think the peers of Entercom have, by and large, actually failed? And sort of how do you think about that and the actual industry and what other people have done wrong?
Yeah. So here's the scary part. The thing they did wrong was taking on a lot of debt and acquire other radio companies, which is exactly what
like they're following the playbook.
Yeah. Yes. Exactly.
Yes. So it really is like obviously the lever. And I could see being a company that you probably would lever up more because it's so capital light and it's a business that obviously is extremely free cash flow generative. So you could look at it from that regard. But yeah, definitely. I know like iHeartMedia that and you wrote about it as well, that they filed for Chapter 11 bankruptcy as well, and they were levered to the hill.
But the other radio companies took up way more debt than Entercom. Mm-hmm. For instance, iHeartMedia, they took up $20 billion, or they have a $20 billion debt load, while Entercom has $1.8 billion.
Which is like what you wrote, I think, like 12 times EBITDA or something like that. Sorry, debt to EBITDA, excuse me.
Yeah. Oh, I'm sorry?
No, I said I misspoke. Yeah, debt to EBITDA.
Yeah. So it's trading at it has at the EBITDA of 4 times right now. Entercom.
Yeah, so it's totally different. And obviously you talked about also and when you, I guess, the testament to management's confidence in the business, since the stock falling from 10 to 7, it's definitely noteworthy of the chairman buying up of his personal money as well, the stock outright.
And it's just it's not just after the stock drop, after the quarter one results. He's been steadily buying shares since May of 2017. And it's very interesting. It's very interesting because back then he owned a bit over 1 million shares of Entercom. And right now, including like his spouse and his trust, he owns 13 million shares, according to his most recent Form 4. Yeah, so he's steadily, over the past year, acquired 12 million shares. And it's all in the open market.
Okay, so I know you think he's honest and competent, but how optimistic do you think he is? Do you think he might be a little too optimistic about radio's future and what they can accomplish here?
It's very possible that he is. He's old. He's an old guy, so he's not the most reputable source for telling like where radio is going from now. But it's certainly a good sign that someone as high up in the Entercom system or hierarchy as the founder is buying that many shares. And the last time he bought shares in the open market was in 2010. And after he bought shares, the stock rose from $8 per share to $13 per share. So he has his history is reputable.
Yeah, you have a chart of that, a table of that in the write-up about how successful his past purchases have been.
Yeah, I do.
Yeah.
So how do you think the combined company is going to look now?
Well, they're projected to get synergies worth $800 million just from the merger.
Do
you feel pretty comfortable in those projections?
Sort of. I think you should take it with a grain of salt.
Yeah, sure.
But if you look at the if you look at the investor deck, if you look at the presentation after the merger, then you can see kind of where they get. It's not like just throwing a number out there saying, okay, whatever, $100 million. They're actually saying like, okay, we're going to get $20 million from here, from cutting overhead or whatever. We're going to get $20 million from here, and then $30 million from here. So they kind of walk you through the process of how they're going to gain those synergies.
So Andrew and I looked at this stock for our managed accounts, looking very preliminary at it, considering it. And one thing that I looked at and said, kind of coming to a conclusion on it, is if you look at the last, as best I could tell, the last 5 years or so of CBS radio, if you take the trends that they were having at the station level and project them out, this company is not going to survive. But if you take the trends that the old Entercom part had and projected, this is a home run. So it's really has a lot to do with the operations level at the station level.
Mm-hmm.
Yeah. So I think they said that they fired quite a lot of station managers and made some other big changes.
Yes.
Right. They changed format even for some of them. So they actually completely changed what the station's format is, what programming it has.
Yeah. Right. So Entercom. Yeah. Exactly. And Entercom has proved to be, without a doubt, the most efficient radio company in America. Like, they bring in more revenue per station than any of their other competitors, and I'm talking way more, like 5 or 6 times more in revenue per station than their closest competitors. And they also bring almost 2 times more listeners per station than iHeartMedia. So I think that proves the competence of the management and how they're able to generate the most revenue and earnings from their stations. So if they manage to implement that strategy on CBS Radio, which is a failing radio company, like you're saying, this can be a home run.
Mm-hmm. So do you have any ideas about how that's possible, that they can get those results compared to other radio station owners?
Honestly, not really. It's not like screaming in my face what the reason behind this is, because they're operating in the same markets as their competitors, and they have very similar stations as their competitors, like snooze, sports. They have diversified stations, so there's no obvious reason why that should be the case, and there's certainly no natural reason why Entercom should be more efficient than their competitors. So I think that might indicate that a lot of this efficiency is coming from the way they run the company.
Right. But we just have to kind of trust that they know radio and that they're capable of doing that. We don't know what secrets they have in terms of how to drive station revenue so high. Yeah.
And it's like Entercom is a better business than their competitors all over the place. They have higher EBITDA margins. They have EBITDA margins averaging 25%, while its competitors are averaging like 15%, 20%. Mm-hmm. So they bring in more free cash flow. It just seems like they're doing everything better than their competitors. So if it's one radio company that's able to acquire other radio businesses and then turn them around, it is Entercom.
Yeah,
and they've done this in the past too.
Yeah, and I think it's pretty noteworthy too. You had said earlier in the podcast that that there's only been 2 CEOs. The CEOs, or the current CEO, he's the son of the past CEO, correct?
That's correct.
Yeah, so I mean, you could kind of say that obviously his legacy, sort of, and his family's legacy lies on this, I guess, working out. So there's a huge incentive there for the business to be highly successful.
Mm-hmm. And this is not like a crazy experiment from the son. It's not like something he's just trying to do. They have acquired other radio businesses in the past and acquired tens of other radio stations in the past, and then try to turn them around or try to implement those stations into the new business, and then manage to outperform their competitors. So this is not the first time they're doing this. It's the first time they're doing this where the company they're taking over is 3 times larger than themselves, but it's certainly not the first time that they're acquiring something that's bigger than the old company.
So have you read the book The Outsiders?
I haven't.
Oh, okay.
About this, yeah, sure.
Just because it reminds me of this company reminds me of that, taking on a lot of debt to take over a company even bigger than them, and being the best operator.
Who's it remind you of?
It reminds me of several. It reminds me of a theater chain that they talked about there. Yeah, there's a couple. Because they're using debt, they're buying a lot themselves, buying back stock. So are you happy with their capital allocation?
You know, I'm torn about it. I'm not really super psyched about it. They've spent a lot of money on merger and acquisitions that it's not obvious that they have succeeded. So right now they're planning on basically do a bit of everything when it comes to capital allocation. They'll pay a dividend yielding 5%. They'll buy back 5% of their stock every year. They'll leverage down, and they will increase their market share by acquiring other radio channels. But this is a high free cash flow company. They generated about $60 million in free cash flow annually prior to the merger. And while they spend most of that on paying down debt, they will focus on doing a lot of other stuff in the future. They have authorized the $100 million stock repurchase program, and they expect to buy back $30 million worth of stock in 2018 alone. And then they will pay $40 million worth of dividends annually. So that's a bit more than $100 million that will spend on paying down debt. And then the company will need $400 million to get to their leverage target of 2.5 times EBITDA. So they will pursue strategic acquisitions, and they will pay down debt, and they'll pay a dividend, and they'll buy back stock. Okay, so you got everything in there.
But if the stock price stays cheap and they ever need access to capital, they need to tap the public markets, that can be a problem. So what's their debt situation in terms of how long out do they have it, this debt?
So they have 1.8. Wait, what's your question here?
What the maturities on the debt. So how far out are we talking before they have to refinance things?
Oh, I think that's in 2021, if I'm not mistaken.
Okay.
It's not right away.
Okay.
But they did some refinancing prior to the merger, which is why they didn't generate much free cash flow in 2017, or nothing. They generated nothing in 2017.
So let's put this in perspective for people. So what kind of let's compare the debt that they have right now to their market cap, basically.
Okay.
Okay. So what's their debt load?
1.8 million.
And what's their market cap?
Billion. 1.1 billion.
Okay. So they are going to rely on the fact that in a few years, I mean, for this stock to work out well, you do need them to be in a situation where they can borrow well in a few years, right?
Yes.
Okay.
Yeah.
Do you see any risks why the market wouldn't be willing to lend the money in the early 2020s?
Well, if they manage to generate as much free cash flow as they're promising, then that shouldn't really be a problem.
Okay.
Because right now the executives are saying, or the CEO is saying, that they have a free cash flow in the high teens, or they said that when the stock was at $10 per share. Now it's at $8 per share. So that's a free cash flow yield. If they are not lying, that's a free cash flow yield of over 20%.
So why do you think the stock went down after you wrote the write-up?
Well, they went down. Well, first, they probably went down on selling pressure.
Wasn't it right after earnings, I think? Didn't earnings come out or something?
Well, yeah. So first, they around the merger, it was trading at $12 per share. Then it just slowly drifted down to $10 per share in May. Then they missed Q1 revenue numbers by about 10%, which sent the stock down 20% in one trading day, in one day. And then it basically fell every single day before it bottomed at $6.30, like 2 weeks ago. And now it's up 25% from that, and it's now at $8 per share, or $7.90 per share.
Yeah, it's been a volatile stock for sure.
Yeah, very volatile. If you pull out a chart, you'll have a lot of questions.
So do you when they did those earnings calls, did they give any information on same station revenue or same station audience numbers?
It was down about I think it was down 2%. Same station revenues were down 2%.
Okay. Because I assume, in the long run, what we care about is their audience numbers, same station, right? Because advertising stuff can be a little volatile.
Right. Yes.
And are they on track with the synergies that they were expecting?
They said that they were actually they were doing better than expected in their earnings call.
And is this a stock also a heavily shorted stock or not?
Is this what?
Is this also heavily shorted or not?
Oh, actually, it has I think about 5% of the float is held short.
Okay.
But if you go on like Yahoo Finance, it's going to look like 120% of it is held short because they're using the old share count.
Oh, okay. Yeah, of course.
But yeah, I think it's in between 5 and 10%, if I'm not mistaken. So it's a heavily shorted stock for sure, but it's not like GameStop heavily shorted.
Okay, so who do you think's selling? Do you think these are the former CBS Radio shareholders? I mean, the former CBS shareholders.
That would make a lot of sense.
Okay.
Because CBS Radio remember CBS Radio was 3 times larger than Entercom.
Mm-hmm.
So the CBS Radio shareholders would actually hold 70% of the Entercom stock. So that's why I said that the whole merger would put a lot of selling pressure on the stock, because these shareholders did not buy Entercom. They did not buy Entercom the company. They bought into CBS Radio, and now they suddenly own Entercom shares.
Mm-hmm.
So it would make sense for them to just try to get rid of their shares, especially after the stock has fallen from $12 per share.
Yeah,
when they got it.
That probably just obviously increased the selling pressure.
Yeah. Mm-hmm.
So you got a lot of comments about this write-up on focused compounding. Do you remember what some of the comments were about, and what were, if any of them were interesting?
I got some interesting comments, but most of them were like they were coming with their views on my write-up, and they were basically like questioning, okay, how about this? Is this correct? What if this happens? And if there's a recession, what will happen? And a lot of them were asking for your guys' input on the stocks. So do you guys you ended up discussing this stock in person?
Yes,
absolutely.
Correct? Yeah. I think this is
did you come to some sort of a conclusion, or
we did? I think we did say that this is a stock Joel Greenblatt would probably love, right?
Absolutely.
Yeah.
And I thought I said on the probabilities, I like it.
Oh,
because I think that, look, on the downside, you can only lose. Your loss is limited. You don't have to lose what the bondholders lose. So your loss is limited to, what is the price that we're at now?
$7.85.
Right. And then what's the upside that you can have?
I mean,
and then what's the probabilities of that? So I mean, if you could make 100 bets like this, I don't have a problem with it at all. I think the probabilities look good.
Mm-hmm.
We do what, 15% that we put
16%.
16% we put into a normal position for us. I don't know, 16%. For us, this is a very heavily leveraged company.
Okay. Yeah. Well, yes, it is. So this is sort of one of the most risky stock. I think you actually said this is the most risky stock you'll possibly ever own.
Yeah,
you're not going to own a riskier stock than Entercom.
I think that's true, and definitely in the sense of financial risk. Yeah, definitely.
Oh yeah, definitely. So we discussed GameStop, and I think that the Entercom business is less risky than GameStop.
Yeah, absolutely.
But financially, Entercom might be like GameStop actually has net cash.
Sure.
Entercom has a lot of debt. So financially, Entercom might very well be a more risky stock than GameStop, even though I think that the business contains less risk than that of GameStop's business.
No, I think that's a great point. And how did you think about valuing it potentially for Entercom?
So I basically valued Entercom in a very conventional way, more conventional than I did with GameStop, using publicly listed competitors, because they have a lot of competitors that are listed, and they're trading at an EV/EBITDA in between the range of 7 times EBITDA and 12 times EBITDA, averaging 9.5 times.
So you took a range. Did you look at like past acquisitions, or did you take a range of where they're currently trading today?
No, where they're currently trading.
Gotcha.
And basically I projected what their EBITDA might be in 2018, and then I didn't really project. I just took a more conservative version of the company's own projections of 2018 and 2020 EBITDA, and then slashed a 9.5 times multiple on that EBITDA figure. And then I also assumed what their debt levels would be in 2020, assuming a 3.5 times leverage, which is what they're targeting.
So you think they're going to pay down some debt by then?
Yes, I do. Well, they will.
Yeah.
That's their plan.
Mm-hmm.
Yeah. But for us, I mean, in general, just for listeners here, in general, if you're carrying more than 3 times debt to EBITDA, that is a highly leveraged company.
Yeah.
Like, for that to be your final target, is that means that you intend to stay pretty highly leveraged consistently, which isn't unusual for radio companies or for media companies generally. So why do you think if this company has the best operators, the best management, and has some of the lowest debt load, people are willing to pay pay higher EV to EBITDA multiples for peers?
Well, that's why this is an interesting case, because this seems like an obvious mispricing, or it seems like a mispricing.
So do you think it's the reverse Morris Trust is such a strange way of doing this kind of deal?
Could be a lot of factors. That, and then he hit on the point of CBS shareholders now owning this new Entercom stock, and then the price falling, and just
I don't think we explained what a reverse Morris Trust is. Do you want to explain what a reverse Morris Trust is to listeners?
You can do it, Geoff.
Okay, so reverse Morris Trust is it's a way of getting around a tax issue of basically selling a company without having to pay taxes on it. So CBS Radio gets rid of a business, which actually is the bigger part, by spinning it off when really they're spinning it off into Entercom. So Entercom is really the acquirer for economic purposes, but for these tax purposes, they get to treat it like they're spinning it off. But as a result, what that means, which you just said earlier, is that most of the shareholders are people who got this as basically a spin-off.
Yeah, which probably could have created, I agree with him when he said that, it could have created selling pressure, especially in, when the stock's falling 20% in a day or whatever.
Yeah. And we should point out reverse Morris Trust is pretty rare these days.
Yeah, although we have come across another one.
We have come across it, but this is something that was much more common. That was much more common almost more than 20 years ago.
Really,
80s through the early 90s or so. Yeah.
Wow.
So I'd say it's rare. Yeah. Do you remember what we came across that was a reverse Morris Trust?
It was
okay.
No, it was Staples and
Staple. Ascendant.
Ascendant. There you go.
Yeah. Okay. Yeah. So that was also planned as a reverse Morris Trust. Yeah.
Yeah. So what price did you think that it could be worth? I don't know if we actually hit on that.
We didn't. I never got that there. So basically, I got like two different figures for an enterprise value for 2018 and then 2020. Divided that figure by their 140 million shares outstanding, and I got a share price for 2018 of about $18 per share, and a 2020 share price of $22.5 per share.
Yeah, so just a lot higher.
Yeah. Yes, a huge upside.
Sure. How would you think about, Geoff, sort of the odds and I guess pricing this?
Yeah, I think about it in terms of the odds. What are the odds? So we can do this. We can just calculate on the downside. It could go to 0.
Yeah.
All right. And then you assign some probability to that, but then you assign probability to how high it can go on the other side and see if that outweighs it, basically, right?
Yeah.
So if you're thinking about it and you look at it and you say, okay, well, I think it can triple or quadruple or something, right? Well, then you can think about how big the probability would have to be of a loss here. And I think that right now when you think about it, it's pricing in a very high probability, I'd say, of default here.
Sure.
Yeah. Or at least of massive dilution for some reason or something. It has to be something like that to the equity. Yeah. So what do you think will happen eventually for the stock to go up? Do you think it's that you're going to see shareholders of other radio peers sell and buy into this because this is more attractive? Who will eventually this stock appeal to?
That's very possible. And once people see the free cash flow that they're going to generate year in and year out, and the dividend they're going to pay out, and then that the leverage will continue to go down, I think that people will start to see the value behind this company.
It's still pretty messy looking right now, you'd say, the earnings calls?
It's very messy looking. And the 2017 numbers were also heavily it's just a misleading picture of what the company looks like. I mean, it looks like it's money losing. It doesn't bring in any free cash flow at all. So once people start to realize that this is a company that actually does generate a lot of cash with a competent management team, and once they realize that perhaps radio is not really dying after all, that's when you might start to see that the stock price will increase again.
So how do you feel having the stock go down 20% or so after you did the write-up and having people comment about that and ask you questions about it?
Well, I hadn't bought shares, so I was happy.
There you go. That's a great answer.
But is the volatility something that attracts you to it or that worries you about it? How do you feel about that?
I don't really care. As long as you hold for a long term, it shouldn't really matter that much. Because up until they're going to start buying back a lot of shares.
And we should mention, because of the debt load, that this isn't the market revaluing the whole company by 20% or something. This is revaluing the equity by that amount, which is, yeah.
Yes.
So do you have anything else that you wanted to say about Entercom that we didn't cover?
Well, we did not cover that the FCC are relaxing rules in the industry, but it's not that...
that's true.
They're getting looser, right?
Yes, a lot looser than it's been since the 1970s. Okay. And at the time, things were, very different, and in almost always. So basically the media market hasn't been this free and open since the 1970s. And at the time, FM stations was a new thing. So, I mean, right now, Entercom is probably too leveraged to require additional channels, at least right away. But so are their competitors. So it will be interesting to see if they will expand even more in the future as a result of this FCC ruling, while their competitors are too busy dealing with bankruptcy.
Yeah, that's a really interesting point to talk about, because you would think for the economics of it, it makes sense for these companies, the biggest radio companies around, to merge, to consolidate.
Oh, yeah.
But they can't do it with cash.
Right.
I mean, they can't take on the debt. They can't take on more debt to buy each other with cash. Are we going to see all stock deals? Are we going to see someone else coming in to finance these things to consolidate them? Or do you think this means we're not going to see consolidation?
Actually, right now, I think that they will stay as they are and will try to deal with their own problems, and then eventually try to acquire other channels and start to, try to create a monopoly within certain American markets.
Mm-hmm. What
do you think?
That makes sense. That makes perfect sense to me. So for those who don't know, the FCC rules required media cross ownership for different things at a time when most Americans in a local area were getting their news from, if there was one newspaper, then most people were only getting their news from one newspaper. If there was one TV station, so there was a reason why they insisted on there being a variety of radio stations and TV stations that had different owners in a local area. With the internet and some other things now, that doesn't make as much sense, and that's what we're talking about here. But so because of that, they were pretty fragmented in terms of how much you can own in each. Their local market share is never that huge, right?
Yeah, no, exactly. They do not own. They can own more than 60% of all the radio channels in a specific market, and one market can be like San Francisco or Dallas or Portland. So, but they're ending this. So what this basically means is that Entercom and other media companies, including TV companies, can own several radio channels within the same market, possibly opening up a door for local monopolies.
Sure.
Mm-hmm. The other thing to consider is there used to be more companies, I think, that had TV and radio than they do now. It's become popular to separate those out.
Yeah. Sinclair Broadcast Group?
Mm-hmm.
Yeah, Entercom bought a lot of, they actually bought their radio channels back in the day. In the 90s or something like that.
Yeah, so this is an interesting one. How do you feel about, I mean, I don't know if you looked a lot at this, but how do you feel about the multiples and stuff that you see on local TV versus local radio?
Well, I think that's a good question, actually. That's a good question. So I'd say that they have a very similar future. People think that, the streaming sites will take more market share from the TV channels and then more market share from the radio channels.
Mm-hmm.
It's like cable TV is dying, radio is dying. It's the same story here.
Mm-hmm.
But it doesn't seem like the TV channels are going through the same struggles that the radio channels are doing. Possibly because they haven't taken up as much debt.
Yeah, that seems likely, yeah.
Yeah.
Cool. Well, you have any other thoughts for VetLife? I thought it was a really good discussion.
Yeah, that was great.
Thanks. Yeah, I agree.
Well, thank you very much for coming on, and obviously everyone listening, and we have said it, he's a regular contributor at Focus Compounding, and he always writes up really high quality ideas and high quality write ups. And thank you very much, Vela, for coming on. And where can people find you on Twitter if they want to go ahead and follow you?
On at Vetle Forsland, or VETLEFORSLAND. That's my handle right there.
Perfect. Well, we want to thank you very much for coming on. We know it's late where you are.
Thanks for having me.
We really appreciate you coming on, and of course, always contributing to the website and being an active member on there, and even with your comments and always giving some great insights. So we thank you very much for that.
Yeah, it's my honor.
Cool, man. Well, we want to thank everybody else for tuning in. We hope that you found this a productive podcast. It was a lot of fun, certainly for us, to talk about ideas that have been written up from our members on the website and talk about them here publicly on the podcast. If you do want to get access to Geoff's weekly memo that he does send out, go to focuscompounding.com, and on the homepage, you will see a spot to enter in your email. And then what that will do is allow you to receive a weekly memo from Geoff on Sunday every week. And it's on an investing topic.
Yes.
Never on a stock, but an investing topic.
Right. And if you want stock stuff, like you just heard today, this particular write-up, the write-up on GameStop, all that, you go to focuscompounding.com, you put in the promo code podcast.
Podcast.
And
PODCAST.
That gets you $10 off a month for the membership for all these write-ups.
Perfect. Well, we want to thank everybody for tuning in. Vetla, thank you so much. Everybody else, have a great day. Take care.